How to invest during a crisis. The indicators of an impending economic crisis are widespread, from the war in Ukraine and rising interest rates to skyrocketing inflation and declining economic growth. When a financial catastrophe, war, global recession, trade imbalance, etc. seems imminent, people often talking about shifting money to safer investments and raising government deficits to prevent the worst from happening. And usually, in an effort to make profit, investors are increasingly placing their money at risk while being unable to reliably estimate their future returns due to the growing uncertainty in the market. Hello there guys, and welcome back to Econify. Today we're going to be looking at different ways and means you can invest your money in these bad economic times we find ourselves in. Make sure to stay tuned till the end of the video, like this video and subscribe if you haven't. Ready folks? Aye aye Captain. Let's dig in. According to a Reuters survey conducted in June, over 40% of economic experts anticipate a recession coming in the United States over the next 2 years. And it appears like events in one region are having an even greater effect on the rest of the globe. It is likely that you already know this, if you regularly keep up with businesses and economic news by reading the paper or turning into relevant news channel. Now, the widespread worry that the UK may enter a recession is reducing investors' confidence in British enterprises. Just this week, we saw a change in the UK Chancellor position due to the dwindling economic policies and budget issues. The FTSE 100 index, which measures the performance of the 100 largest companies in the United Kingdom, has experienced large price swings recently too. To make things worse, Russia's unlawful invasion of Ukraine has had a significant influence on the global energy system, altering supply and demand dynamics and driving up energy costs for many consumers and businesses around the world, impacting low-income people and businesses in emerging countries disproportionately. In addition, it's been terrible for investors trying to figure out which energy projects to finance. So yeah, the world is in a pretty big crisis. But you've got a lot of options. There is no way to predict the short-term course of either the economy or monetary policy. And the Federal Reserve has got the ability to keep shooting up interest rates, which might have a negative effect on bond prices if inflation remains high. Now, despite that, many industry experts, Stephen Lively for example, feel the worst of the destruction is over, stating that bond investors may find the current climate very appealing. When interest rates were near zero in the past, investors had to purchase riskier bonds in order to generate a decent return. Recent increase in rates, however, suggests that you can stop searching hard for it. Investors now may diversify their portfolio with a variety of bonds delivering high yields without taking on larger potential negatives of riskier investments like equities. While everyone else is freaking out and the market is plunging, you can lay the groundwork for more financial success than you could have imagined, only if you start now. And here's how you can do it. First on this list is devise and follow an investment plan. In times of economic crisis and uncertainty, you should prioritize a long-term perspective and remain committed to your investment strategies. It is a tricky game to actively invest in stocks and time market downturns. You might want to ask hedge fund managers about that. A long-term investment strategy takes into account an investor's risk tolerance, investment objectives, and investment horizon. Besides, keeping the right asset allocation and adjusting the portfolio according to the current market conditions is more important in the event of a recession. Many experts agree that the key to long-term investing success is avoiding panic selling. For example, a $100 investment in the S&P 500 in the 1920s or the 1930s that was held until about 2020 or last year would have grown to over $16,800. On number 2, invest in safe haven assets. To avoid losing money during a recession, investors shouldn't just sit on their hands and wait for the market to recover before making any new investments in safe haven assets. That's why people refer to them as safe haven assets. Why? Because they lessen the danger of a portfolio. Many experts, however, stress the importance of investing in such assets before a recession starts, so you may want to get on it sooner rather than later. When it came to constructing the Ark, Noah did not sit about and hope for rain. There is a double risk of bankruptcy for businesses that invest too heavily in high-stakes ventures. I'll advise rather that you go with businesses that are not vulnerable to fluctuations in the economy. Some industries are thought to be immune to economic turndowns, such as those involved with healthcare and the food industry, because they are poised to amass large investments over the next decade. If you really looked at COVID times, these companies with healthy financials going into the pandemic fared the best. On number 3, hold defensive stocks. Your portfolio's value can be preserved during a crisis by investing in defensive stocks. When the economy is doing well, equities in the consumer discretionary sector usually rises sharply. They are known as cyclical equities because their performance is inversely correlated to the growth and decline of the economy and consumer confidence. However, utility stocks and consumer staple stocks are examples of some defensive names in non-cyclical sectors that typically see less volatility because they provide necessities to the broader public. These utilities have recession-resistant demand, which propels the industry ahead of the broader stock market. While going out to some big fancy restaurants may be out of the question, the need to eat remains and the demand for groceries tends to rise. You'll never believe how many people eat and use things up when they're meant to keep it. Some cheap fast food restaurants like McDonald's, KFC, and Burger King's have shown to be quite robust, likely due to the fact that the convenience of a $2 burger is pretty much hard to resist. Such businesses are excellent investments during economic crisis, since they maintain or even increase in value as the downturn continues. On number 4, don't try to day trade. Most people tend to believe that trading applications have all the data necessary to understand the behavior of market and their impact on economy. Well, it's only a simulation, and while the information presented there is plausible, it is still a hunch. Now don't get me wrong, I think they are fantastic resources for anyone looking to launch a business or begin investing. Zero-commission stock trades and user-friendly trading apps make it simpler than ever to get started trading equities on the side. Sure, go ahead and play around with the modest sum that you can afford to lose. However, investing for a long term is the sure way to build wealth in stock market, so using day trading as a method of investing is typically not recommended. Lastly, you ought to diversify. Diversification is a crucial strategy for investors at any time, not only when the market is volatile. Diversifying your holdings across equities, bonds, and precious metals can help caution the blow of a sudden decline in the value of a single asset class. Diversification is also enhanced by investing in different geographical areas and different types of businesses. For instance, if you put all your money into oil businesses and the price of oil dropped due to the conflict in the Middle East, you would be in a serious danger of losing everything. Now, if you additionally spread your investments among the tech market and renewable energy, your portfolio would be less vulnerable to these trends. Today, many rich people, such as Stephen Cohen and Ray Dalio, have followed the crypto frenzy and placed some of their savings in Bitcoin and other digital currencies in hopes of gaining a return for diversifying their holdings. Bitcoin, Ethereum, and Dogecoin are all assets in which the world's wealthiest man, Elon Musk, also deals in. Since 2011, Bitcoin price has increased by over 20 billion%, making it one of the most lucrative financial assets ever. However, if you want to get wealthy in crypto though, you must be prepared to take on an enormous risk. Should I invest in gold? For some, gold's historical tendency to outperform stocks during economic instability makes it an attractive alternative to stock investments. According to the Bureau of Labor Statistics, the value of gold simply rose sharply during the Great Recession, increasing by 101.1% between 2008 and 2010. When inflation is strong, having some gold on hand can be a good hedge against losing purchasing power in other investments, such as equities. Yeah, so getting a gold bullion is a good investment option for people who have got a sizable sum of money to put away for a long term. No one can predict how long the recession would last, and how much of an impact would it have on stock market. Even if no one is looming on the horizon, the greatest strategy is to invest during a downturn, maybe the same thing you've been doing all along. But the objective is to stay fully involved, not to be blindsided by short-term market gyrations, and retain long-term goals. Even recession and energy crisis can be challenging for return and creating wealth. Okay guys, we've come to the end of this video. Tell us what you think about it down in the comment section, and remember to click like and subscribe if you haven't. We've got amazing content for you too, you don't want to miss out. Just hit the notification button and that's it.